Matthew Bell with insuranceprescription.com, and today I wanted to talk to you about the rule of 100. In a previous video, I talked about the rule of 72. The rule of 72, of course, is kind of a shorthand way of estimating the impact that a particular rate of return is going to have on your money, in particular, how many years it will take your money to double at a particular rate of return. In another video, we dealt with the rule of 85. The rule of 85 is simply a formula that is found in some employer pension plans or defined benefit plans that prescribes when it is permissible for an employee to retire early. Now, the concept of the rule of 100 is related in the sense that it is also going to pertain to your finances, to retirement planning, but it's a little bit different than the other two rules that we have discussed so far. The rule of 100, also called the rule of hundreds, or the 100 rule, it is a heuristic or a rule of thumb designed to provide you with a kind of a guideline for how risky your portfolio can stand to be given how old you are. So the rule of 100 is going to prescribe different amounts of risk for different stages of your life. Now, the first caveat here, the first important thing to realize is that what I have in mind here is market risk or investment risk. There are all kinds of risk. I'll probably do a separate video where I enumerate a number of different classifications of risk. So there's institutional risk, risk that a bank might fail or that an insurance company might not be able to pay its claims, risk of inflation, there's risk of living too long and outliving your money, and needing perhaps long-term care, a number of different risks. But in this case, we're concerned with the risk to your investment portfolio that's going to have to do with market volatility. One thing to bear in mind is that this rule is going, again, to be a rule of thumb or a heuristic. Now, that means that it's going to kind of give you a rough guideline for how to proceed. A number of people are going to deviate for any number of reasons. Now, when you think about risk allocation in a portfolio, there are going to be a number of different aspects to what you will want to consider. But I'm just going to think about two of them. One is going to be subjective and one is objective. So the subjective part, when you're trying to decide how risky you want your portfolio to be, the subjective part is going to be what is termed your risk tolerance. Now, I'm not going to speak to risk tolerance. This is a private kind of a thing. You might be the kind of person who's wired in a particular way where they are okay with being more aggressive and risky, and you might be the kind of person who is very shy about risking anything. Risk tolerance, I'm sure, has a lot of different aspects to it, a lot to explore there, but it's not really the focus of this conversation at all. On the other hand, the objective component of risk allocation in your portfolio is going to have to do with your age, and that is what the rule of 100 is going to speak to. The simplest way to put it would be to make your age a percent. So, for instance, if you are 30 years old, your percent is 30%. Now that means 30% of your investment portfolio, according to the rule of 100, should be conservative. That is to say, out of market risk, minimizing market risk, minimizing investment risk. On the other hand, if you're 30, you could stand to have 70% of your assets invested in the market in riskier vehicles. Why? The obvious answer is that you're 30. If you plan on making this your retirement vehicle, we're talking mostly about retirement planning here, then at the age of 30, rough estimate, you have about 30 to 40 years to go before you have to start to depend on your accumulated assets. In other words, you've got time, if the market were to tank, to ride the wave and hopefully recoup the losses that you experienced. Now, at any point in time, a market loss is obviously regrettable. But at the age of 30, you're in it for the long game. We're going to assume you are not trying to time the market. You are trying to put in place certain long-term investments that you hope will pan off over the course of decades. So the idea is at the age of 30, you have 30 to 40 years to ride the wave. On the other hand, let's consider that you are 70 years old. If you're 70 years old, then you would want, according to the rule of 100, to have 70% of your assets disconnected from market risk. You're going to want to have 70% of your assets outside of those kinds of investments that are susceptible the most to investment or market risk. Now, 30% of your assets could still remain, according to the rule of 100, but this is going to depend on your overall retirement portfolio, how close you are to retirement, are you in retirement, a number of different factors. But again, as a heuristic, this is just supposed to give you a rough guideline. Obviously, the intuitive reason why a 70-year-old is going to want to be much more conservative with his or her portfolio is because that time horizon is either very compressed and very short, or it is non-existent in terms of when retirement is. At the age of 70, many people will already have been in retirement for 3, 4, 5, 6 or more years. And if you are risking your investments at the same time as you're drawing from them, you open yourself up to a number of possible problems and difficulties. One of those is referred to as the sequence of returns risk, and I have a video where I kind of go into that in a little more detail, but the idea there is that your losses, if you experience losses in the market, are going to be compounded if you are pulling money out at the same time. My dad, for example, when he retired at the age of 65, was simultaneously invested in fairly aggressive stocks and at the same time was living on the interest that these stocks were generating. Now, this worked for him until the market completely tanked, and then he found that he had to start tapping into his principal because he could no longer afford to live simply drawing on the interest. However, once you reduce the principal, even getting the same rate of return that he was getting before the drop in value wouldn't generate the same amount of return. And so it caught him in a cycle of perpetually having to draw more and more from his principal. Now, there were a number of factors involved in my dad's case. He probably shouldn't have retired when he did. He also experienced long-term care risk. He eventually got Alzheimer's disease and had to be placed into a nursing home facility. But the real key with the rule of hundreds is simply understanding the fact that what it is prescribing is a way of indicating roughly how conservative you should be with your portfolio, or if you want to think about it the opposite way, how risky you can afford to be given your age. Now, once again, these are heuristics, they're rules of thumb. Many people are going to be aware of this information and think, you know what, I understand that, but I'm comfortable with a little bit of a more aggressive portfolio. I'm comfortable with the risk. On the other hand, some people are going to be far more conservative than what the formula would prescribe. In some sense, this is somewhat personal, especially when we think of the subjective component, as I said earlier, in terms of a risk tolerance. Many 401k plans and other mutual funds may have what they call target funds or target date funds, and the idea is that this rule of hundreds is somewhat baked into the investment strategy such that early on in your investment timeline, you're going to be in riskier stocks, and then as you age, they're going to make you more and more conservative, possibly more conservative stocks, possibly some bonds, things that are going to be considered to be a little bit less risky. Now, the old way of thinking of this, just to give you an intuitive fix on it, was, let's say your portfolio started with a weighting of 60% stocks and 40% bonds, assuming that stocks are riskier than bonds, which is certainly not always the case, then that portfolio would be ideal for a younger person. And then as you age, they would sort of switch that over the course of a period of time, and you would end up with 60% bonds and 40% stocks. This is all very rough. In this day, as I sit here and speak to you in 2019, something, the 60-40 kind of mix is a little bit passé, but I think you get the picture. So the younger you are, the longer your time horizon is, and basically the more loss you can experience and still have the time to recover. As you age, the time horizon to your retirement gets compressed. You don't have as much room to recover, and you need to be more conservative. Some of the buzzwords that surround a little bit of riskier investments might be things like aggressive, growth, small cap, and so on. These might include high yield bonds or junk bonds, equities and stocks, variable annuities, variable life insurance policies, and the like of that. People might even be interested in somewhat even riskier vehicles, and this would be things like emerging markets, junk bonds, penny stocks, and other vehicles along the lines of this. But again, as you age, your portfolio is going to become more and more conservative, at least ideally, and according to the rule of hundreds, it kind of gives you a metric for gauging that. If you know that you're 60 years old and your portfolio is 100% invested in aggressive stocks, then you might just think, you know what, based on the rule of hundreds, I might want to correct that a little bit. On the other hand, if you're 30 years old, as we just used the example, and you're invested completely in CDs, earning you 2%, you might want to rethink your investment strategy, because you are unlikely, given that kind of investment trajectory, to build the assets that you would need for retirement. Now, having said some of this, I should break in and immediately tell you I am not a financial advisor. None of this is intended to be financial advice. This is for general, informational, or entertainment purposes only. I'm simply giving you the overflow of some of the research that I've done in the hopes that something might be of interest to you. Now, some words that are going to be a signal that an investment vehicle is a little more conservative. They're going to include things like blue chip, fixed income, stability, large cap. So if you see these words in your allocation, it's an indication that you are more conservative. Examples here are going to include things like low yield bonds. They're going to be higher grade, but they're going to give you a lower yield. Cash positions, certificates of deposit or CDs, dividend paying stocks, life insurance that is whole life rather than variable, money markets, savings accounts, treasury bills or T-bills, and things like this. In the more conservative vehicles, really the name of the game is going to be the fixed interest rate that you receive, the guarantees you have, as well as the question of whether or not those vehicles will keep pace with inflation. But in general, the rule of hundreds is going to be a kind of a rough and ready way to give you a sense of how conservative your portfolio is compared to how conservative maybe it ought to be. But once again, all of this is simply a heuristic. Your individual risk tolerance is likely to vary. And all of this should be done in conjunction with your money manager, with your account, with your mutual fund manager, whoever deals with your custodial plan through work. All of these people are going to be resources that you can draw from, have a conversation with, and they can help to build a plan that's right for you. If you found something useful in this video, please like it. Please subscribe to the channel. Please click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.